Good morning, ladies and gentlemen. Welcome to our first session this morning, Inspection, a performance update by STR. Dive into the pulse of Benelux hotel performance with exclusive insights on revenue, ADR and operational costs. Uncover key trends, benchmark against global and European standards, and equip yourself with the tools to elevate your hotel's success. Michal Rao, MIH, Regional Manager from Northern Europe at STR. Thank you. Over to you, Michal.
Good morning, everyone. So I'll jump straight into it. So I'll take you through performance updates globally, Europe, and then bring it down to Benelux as we go through the slides. Just a quick introduction on STR, just in case anyone's not heard of us before. I hope that everyone did, but it still happens. So STR is global benchmarking provider for hospitality, for hotel industry. We're collecting occupancy, average rate, RevPAR, and a lot more from hotels across the globe. So we've just last year passed the 80,000 hotels mark globally and 10.5 million rooms across the globe. Like I said, it is the top line, so the occupancy, average rate, and RevPAR. We're also looking at forward occupancy on the books, monthly P&L, business segmentation of transient group contracts, and so on. Being part of the wider CoStar group, we also pull in the commercial real estate insights, looking at sales of hotels, but also commercial properties like offices, industrial retail, and so on. So jumping straight into the data and looking at the occupancies across the world and the percentage change on last year, you can see that we're starting to return to some sort of a normal increases in single digits pretty much across the world, with some exceptions on the Far East. So in mainland China and in Asia, we're seeing a lot bigger increases year on year. That comes down to China releasing their restrictions on COVID, allowing international travel both for Chinese out of China, but also inbound from the rest of the world to China. The rest of Asia has seen a lot more demand coming in from the European markets and overseas, with a little bit more faith in the market and less concerns over travel disruptions and so on that we saw in 2022. So there was a lot more return of that long-haul leisure demand coming into the destination. Looking at Europe and the demand index to 2019, so comparing it to the same time in 2019, you can see that it's been gradually going up. And as we went into 2023, we started to see the demand levels to kind of hit the 2019 levels, or even surpass it when we look at that last month there with December 2023 being already 1% above the 2019 levels. Now, unfortunately, it does not mean that the occupancy levels are at the same levels of 2019, because hotel developments have not stopped. There are plenty of new hotels that have opened across the world, so we're still a little bit behind, but we're talking about now small, lower single digits, those 4% in Europe, North America, and so on. So we're starting to get there, starting to get to the occupancy levels that we saw before hitting those high 60s and 70s on annual level. Now, different markets across Europe have performed slightly differently. UK and Ireland, thanks to domestic demand, a lot of domestic demand, drove the occupancy levels to hit 100% of what we had in 2019. In those countries, then Southern Europe, obviously with a lot of leisure demand, people starting to want to go back to holidays and go to the beach and get some sun over the summer, have seen a lot more of that occupancy to return and start to drive a lot more demand. And as you'll see later, the rates. In Western Europe, obviously, Benelux is there, still about 6 percentage points behind 2019 levels, but again, starting to get there because you have new hotels coming into the market as well. Now, across Europe, looking at percentage change to 2019, so you see that pretty much all market, bar a few, are still reaching for the 2019 levels of occupancy. Edinburgh had a really great year in 2023. I would say almost equally good in 2022, with a lot of leisure demand coming in domestically from Europe, but also long haul with the return of Americans into Europe, as you'll see a little later on. The other two outliers there are Warsaw and Vilnius. For those two markets, Warsaw, obviously the proximity to Ukrainian borders, a lot of the humanitarian help or dignitaries and press kind of go through Warsaw, either fly in there and then take a road to get to Ukraine. So a lot of that demand's been going there. And we're speaking of a market that's been well developed already before the pandemic, with busy occupancies, so they're already growing on that. With Vilnius, they obviously had a NATO conference that lasted, gosh, how long was it? It was about a month, or just over a month, in Vilnius, with a lot of things happening related to the conference before and after. With a small condensed market like Vilnius, we've seen obviously a lot of occupancy come into it, and compared to 2019 levels, we saw some increases there. Otherwise, year on year, like I said, we're starting to see that healthy growth. It's no longer those 15, 20, 30% as we saw in 2021, and potentially for some markets even in 2022. But most of Europe is starting to look at those single digits. Again, we see some exceptions there in Central Europe, around Germany, Czech Republic, Austria, and the region over there that's been a little slower to recover when it came to occupancy. Germany had the restrictions on COVID for a little bit longer. The masks and things like that lasted a little longer. A lot of the conferences were pushed because of that, and Germany being a heavy conference led market didn't see as much occupancy, so we saw some of those returns in 2023. Now, looking at occupancy index to 2019 across the markets in Benelux, there are some outliers that you'll notice straight off. There's Cologne and The Hague, with some corporate demand coming in on those dates in the middle of 2023. We have slightly different markets there towards the end when we look at that January and February. So those listed there at the top. Again, all of those are pretty much a little bit more corporate-led than the others, but hovering there around that 100% of 2019. So we're starting the occupancies to come back to where they were, even in Benelux, on all the regional cities. When it comes to the actuals over the last 24 months or 12 to 24 months, obviously Amsterdam city centre leading the way, being the leisure, but also benefiting from corporate demand. Amsterdam's always been very strong when it came to occupancy across the board, so really leading the way there, with some of the other markets kind of coming in and trying to take the top spot, at least for a little bit, with the markets like Bruges coming in strong in Belgium. Now, looking at Benelux in a little bit more detail, and where do we see the occupancy sit? And obviously, it is the independent hotel show, so we did have to look at brands versus independents. Now, one thing I always have to mention is, for brands, we consider the likes of Curio Collection, Autograph Collection to be a brand, although they are collections, but they do come with a whole lot of restrictions and benefits from the brands that sit above them. So those kind of brands sit there. In terms of independence, we generally see our sample for the independents to be in the top 4 classes that we track, so a little bit less on the economy and mid-scale side, although we do have obviously hotels there, but the independents that participate with STR and then contribute towards the data tend to be in the kind of higher classes from upper mid-scale to luxury. So it's just a little bit of context there when you're looking at some of the data and it looks a little skewed, that might be why as well. But in terms of occupancies, fairly equal performance, but the independents are taking a little bit more occupancy compared to the brands, so a little stronger recovery, although it's only 2 percentage points difference, really. Now, moving into the rates, of course, compared to 2022, we have seen growth in ADRs across the board. So the entire slide is done in US dollars, so just caveat that as well. Single-digit growth, again, across the board. There are some exceptions to that. Again, mainland China and Asia, return of that long-haul travel obviously boosted the ADRs on that front. Northern Africa, there's some currency devaluation, so that always drives that percentage change, which is a lot harder to account for when you're looking at this. And then Middle East is 1% behind 2022, because we're looking at year on year. That's because obviously Dubai had Expo, Qatar had the World Cup, so a lot of things that happened in 2022 were not happening in 23, but they still managed to hold their rate pretty much at the levels that they did in 2022, which is, I think, a great testament to those markets being resilient and really pushing for their rates. Now, looking at percentage change to 2019, a very different picture. I think the hotel industry in particular, and I always feel like it's a little bit unfair that the hotels get the stick for charging more than they did in 2019. I don't know how many of you flew here, but if you've flown anywhere in the last 2 years, the flight tickets are not any cheaper than they were in 2019. Everything's gone up, but we hardly ever talk about the airlines, the trains, and everything else around travel that has increased prices, but we always talk about hotels that charge outrageous prices, or that the rates have gone up by 30, 50 euros, 60 euros in a market, but we're not talking about how you get there and that everything else has increased. You will see later on that when we take out the inflation, those numbers are not as exciting as they might look on the surface. And that's what we have here. Across Europe, you have 2 different things in there. So the higher portion with the higher number is your index to 2019 for the ADR, for the nominal amount. So like I said, if we've gone from 100 to 150 euros, you've got an index of 150. But then the darker portion that's a little bit lower is your actual ADR index if we strip out all of the inflation for all the years between 2019 and 2023. And you see that we are growing ADR, but we're really growing a little bit. It's not too much. It's a single digits or maybe 11% growth there on one of the months. But we're not seeing the crazy amounts of 30, 40%, because you do pay a lot of that in taxes, energies, labor, and all of that. With all of those things coming up, the prices had to come up as well. Now looking at actual ADRs across the markets, again, the same selection of markets. Anyone surprised by the yellow line there at the top? Probably not. Amsterdam city centre always been a premium-led market that's busy and can really command those rates, touching those 200, 250 euros on average. But you do have some of those other markets that sit there on the higher end of the rest, being Luxembourg and now I've lost the other one. Luxembourg and Antwerp. That's the other one. So Luxembourg and Antwerp kind of take the top spot from the rest of the markets when it comes to ADR hovering there around those 150 euros from all of those. When it comes to how much more than the year 2019, it is pretty equal. There is no one who's been really charging excessively more than everyone else. It is more than the 2019 levels on pretty much any given day through this period. There are some exceptions where the markets have dipped. And again, Cologne and The Hague have charged a little bit more than they did in 2019 during those event days that they had in the end of May. Now, ADR recovery, when it comes to brands versus independents, follows similar pattern that we saw in the occupancy levels. Although in occupancy we were really talking about 2 percentage points, here we're talking about more of 5% difference. But both of those segments are growing occupancy, growing ADR compared to 2019 in a pretty much similar manner. Although the independents charge a little bit more. Now remember, they are in higher classes, while the brands go all the way down to the economy brands. That is very much connected to the economy and the GDP growth. We saw the US really bounce back very quickly from COVID and started coming over the 2019 GDP levels. GCC, so the Middle East, started to grow right after them and then surpassing them towards the end of 2023, while Europe had a little slower curve and started to kind of flat out to still increase, but at a much slower pace. So bearing in mind everything that we've looked at in terms of the rates and occupancies, it does make sense because we've had a little slower economy in here. Now, the fact that the US was able to bounce back a little quicker, the currency exchange has been a little bit more favorable to them. That just meant that we've seen the return of American travelers, especially in 2023, over the 2019 levels. So we've had more Americans coming into Europe in 2023, especially over the summer period. Now, this year might be, again, a slightly different scenario because it is the election year, and the Americans tend to travel a little bit less when the elections are on because they do want to make sure that they're home to vote. And the election year is always a little bit less stable in the US. So as soon as something like that happens in the US, they tend to travel a little bit less. So the election year is never really that exciting for their travel. But we've seen a lot of that come back, and that has really helped some of the ADRs across Europe. Obviously, there is the currency devaluation in Turkey, but everything else, you saw the Southern Europe and UK and Ireland really benefiting from the American travelers, who are known to spend a little bit more than Europeans would when they travel around Europe. When they want to stay at a Marriott, because they get their points with Marriott, they will stay at a Marriott even if it is 30 euros more expensive than another hotel that they could stay at, but because they want to stay, they will stay where they stay. Now, US has always driven a lot more demand into Europe than China. I learned recently a fun fact that only about 4% of the Chinese have a passport and would travel abroad. So there is a huge amount of untapped demand that can still come from China. There's always been more travel coming out of China pre-pandemic, but the pandemic kind of put a big stop to that, as you see there in 2020 and 2021 when we saw that dip. But we're expecting that to keep growing both on the American side and on the China outbound demand as well. Now, what did that look like across Europe? Now, you've got the percentage change to 2019. Like I said, we have seen some really strong rate growth across Europe, with some markets growing a little bit more than others. Some examples you have there: Edinburgh Paris really charging pretty much 1.5 times the amount that they did in 2019. Now, Paris has always been premium. They didn't have the easiest ride over the last couple of years, so driving the rates from there has been quite, I don't want to say easy, but it has been expected from the Paris market. Now, on the Southern Europe front, Rome has done really well. Obviously, they're charging a lot more. They also had a couple of events that have driven in some high-end demand that would then result in driving the rates up as well. So for Rome, it's not just pure return of leisure, but it is leisure combined with some market events there. Now looking at year on year, similar to occupancy, we're still seeing some strong growth on certain markets, but across the board, we're starting to return to a sort of normal ADR increases year over year. The single digits seem to be dominating across the board. Now across Europe, in terms of class, so you have them there as we classify hotels. So in STR, we don't use the star ratings for hotels. We have our own classification from economy all the way up to luxury. And the way we define it is by ADR performance. So we slot hotels, if they're individual independent hotels without a brand, we slot them based on their individual performance. If they are a brand like a Marriott, Hilton, Ibis, we look at their performance as a brand and then classify them as a single class across the board. So we go from economy, like I said, all the way up to luxury. Now, what we're looking at here, you've got the different colors for the different years, so 2020, 21, 22, and 23. And you see that luxury has really recovered their RevPAR and started growing their RevPAR already in 2022. And interestingly enough, the same thing happened for the economy hotels. So economy hotels have started growing their RevPAR already in 2022, while everything else in the middle kind of had to wait until at least 2023 to start hitting higher RevPARs than they did in 2019. Now, the reason for that is a lot of that new supply that I've talked about already, a lot of it goes into that middle segment, so the kind of 3- and 4-star hotels. That's where majority of the new opening hotels goes. So they've had to fight for their share for a little bit longer to get above the 2019 levels. Now, year on year in 2023, we're starting to see that equilibrium to kind of come to an equal measure of occupancy and ADR. 2021 and 2022 was very much driven by that blue portion with the ADR, and the occupancy really kind of took a back seat, but we're starting to really see that to be now a little bit more equal when it comes to driving RevPAR growth for pretty much all the classes. Again, economy really being the only exception to that, where they've started to drive it out of ADR, because the economy class has always been a little bit busier, and when you start hitting certain occupancy levels, it's really hard to grow further from that as a class across Europe. Now again, coming back to that division of brand versus independence, you can see that when it comes to the branded hotels, really we're talking about the luxury class taking the top spot, where driving the rates and having that 44% increase on 2019, while still being about 16% behind in occupancy. Again, interestingly enough, the ADR growth on the economy side is the second strongest out of all of the classes for the branded hotels. The rest of the class is similar recovery pattern when it comes to the occupancy in those high 90s, or at least over the 90% of recovery, and with similar ADR growth year on year. When we look at the independents, it equals out a little bit more. We're seeing the occupancies to really be in over 90% of 2019 levels. And the ADR growth is, again, for all of the classes, very equal. So on the independent side, we're seeing a lot less divide between the classes than we do on the brand side. West Germany has been slightly different. So because we're looking at, with the independent hotel show here, we're looking at Benelux, but also some of the West German audience. We're seeing a similar pattern that we saw across Europe, a lot more rate growth on the luxury side, a lot less recovery on occupancy, and then a similar pattern when it comes to the rest of the classes. Now looking at Benelux in a little bit more spotlight, looking at the actual cities for their 2023 year-end results. You've got the capitals there highlighted on the screen. Obviously, Netherlands there sits there with pretty much the highest ADR overall on a market level. But Belgium, on a whole, is actually busier with 66% occupancy across 2023. Rate-wise, it's a little bit more equaled out on a country level with Netherlands and Belgium being at about the same ADR with one another. When it comes to RevPAR, now there is a slight error on the slide that we noticed with my colleague yesterday evening. It's not actually indexed performance; it's an actual RevPAR across the slide. So please ignore that little note on the top and the percentage in the box. Looking at the results that you saw on the previous screen, obviously Amsterdam is understandably there at the top with the highest RevPAR, and Netherlands then driving the RevPAR a little higher on the whole. Now jumping into those differences between independents and the brands across the markets. So first looking at Netherlands and looking at Amsterdam and everything else outside of Amsterdam. When it comes to occupancy, the brands really take the lead and are a little bit higher. No, sorry, I'm lying. Independents are a little bit higher on the occupancies than the brands, both in Amsterdam but also in the regions. And the percentage change really year on year for the beginning of this year is following suit in a very similar manner for both of those, for the brands and for the independents. Looking at the ADRs, obviously Amsterdam there being slightly more premium on the rate. But again, the darker line, which looks at the independents, is above the lighter line, being the brands. So the independents are charging a little bit more premium rates. Again, that comes down to the class of hotels that they are. So we have that sample in the higher range. Percent change-wise, similar order, although we're starting to look at a little bit of a slowdown. As soon as the market hits a certain level of ADR, you are looking at kind of maintaining that rate rather than growing it too far forward from there. And Amsterdam already sitting at around those 200, 250 euros. That rate growth is hard to maintain across the board. So at the beginning of this year, we have seen that in here. Now a little busier slide with the regional cities in the Netherlands. The independents are driving the occupancy, similar to before. Now on this slide, we've swapped it around a little bit. So you have the lighter line are the independents, the dark line are the brands, just to keep it a little bit more entertaining when you're trying to follow the slides. So the independents are a little higher on the occupancy levels. Again, a lot of the independent hotels tend to be smaller than the branded ones. So you will have the Marriotts, the Hiltons, the Accors going for the big box hotels, having 2, 3, 4, even 500 rooms, while the independents tend to be a little smaller. So again, driving that occupancy level is to be expected. When it comes to improvements year on year, again, same pattern as we saw on the overall Amsterdam versus regional. We see the independents kind of going for it and really improving year on year, even in the first 3 months of the year, that generally don't tend to be very exciting, right? January to March is always the slowdown. It's always the period that you do the things that you didn't want to do when you were busy, and you can do those things. So it's nice to see that there are improvements across the board there. When it comes to average rate, it's a similar scenario as we saw on the occupancy and on the previous slide. Across the board, the independents are taking a little bit of that premium. On pretty much all the markets, there are some exceptions to it there with Rotterdam towards the end of the year. But otherwise, independents are pretty much in the lead across the board. And then, again, pushing a little harder for the ADR growth year on year. Now, again, that makes a little bit more sense because if you don't have the backing of the big brand and you're really dependent just on yourself and you're a single property owned and operated, you do need to make sure that you can cover all of your expenses, all of your staff, and then at the end of the year make a profit. So it makes sense that there's a little bit more push on the ADR. Now, where is the demand coming from? Across all the markets that we're covering here at the show, pretty much the weekend demand is driving the occupancy levels. The weekdays are there, which is really interesting for me because me covering normally Northern Europe and looking at UK and Ireland a lot, we see it a lot different in the UK. I see a lot of the weekend and shoulder demand going in stronger than the weekdays. So it's interesting to see that in the Benelux it's a slightly different scenario, and that corporate midweek days are doing quite well as the weekends, which is expected with the leisure coming in quite strong. The weekends are obviously the least affected days at this point. They are still not where they were in 2019, unless you're in Rotterdam, and then they are already over the 2019, both for the weekends and for the shoulder nights, but the weekdays seem to still struggle a little bit behind 2019 levels. Now, when it comes to rate, it's a little bit of a mixed bag, depending on which market you're in. That premium occupancy is driving that premium ADR as well, a little higher, especially in Amsterdam, Cologne, and Rotterdam. Makes sense with the weekend demand with a little bit more leisure. But then some of the other markets, it's interesting that Brussels doesn't have a higher rate on the weekends than it does on the weekends, because it had a lot more leisure coming in and a lot more weekend getaways going back into the market, especially compared to 2019. So I was expecting that line to be a little stronger than the midweek, but it makes sense that Brussels has got a strong midweek with the demand that goes there during the weekdays. Now, comparing it to 2019, even though it might not be looking as strong, it is a huge improvement compared to 2019, especially for Brussels. Now, looking ahead, what's on the books right now? So as of now, the data in the slides is as of last Monday, because our forward-looking data processes every Tuesday evening. So with the presentation being today, that's the most recent that I could have. Most markets across Europe are having better on the books than they did last year. So we're purely looking at occupancy on the books, and that seems to be coming in stronger pretty much across the board with some exceptions there. Now, looking at the markets across Benelux, there's lots of events on both the corporate side and the leisure side. So you've got Tomorrowland on there, Taylor Swift concert that's been driving absolutely insane occupancy and rates across the world. So one concert there and lots of expos and conferences really bringing in that good base for the markets that they are in. Now looking at Amsterdam year on year, so the same time last year, what they had on the books for the same dates that you can see there at the bottom. It's a mixed bag, but on an average, we're seeing a little bit better on the books, although it's really marginal because you have days where it's not as strong. But for the majority of the days, we are seeing that on the books to be a little stronger and a little further ahead than it was last year. Looking at the German cities, a very similar picture. Obviously, they have that small event in July, well, June, July, with the UEFA finals across Germany. So a lot of the markets are really benefiting from that demand and starting to reach out towards those 80% on the books already now in March for June, July. But it's not just that. There's lots of events that you see highlighted there across the board that are really driving strong on the books. So if anyone's trying to book rooms for any of the UEFA finals there, it looks like it's good luck getting anything or not having to remortgage your house to actually book those rooms, because the rates are going to be interesting for sure. Looking at Amsterdam, again, in a little bit more detail, looking at year on year, same time last year for the city center and for the airport. Now, for the imminent 3-4 months, the city center is doing better than the airport, having a little bit more on the books. Well, when you go further out into kind of that month 10, 11, 12 ahead, the airport is having a little bit more on the books than the city center, and that comes down to kind of the type of demand that comes in. Obviously, the airport will have some of that crew business that's a little bit more predictable, and the airlines will know when they need the rooms, and they're all pre-booked in advance because they know when their crew has got layovers. So we're seeing a little bit more of that in the airport towards the kind of tail end of the 12 months. Now, switching from actual on the books to where do we see the performance going for a forecast, we're quite confident that Europe is going to continue to grow. So what we're looking at here is the European markets that we forecast in STR. Now, we don't forecast performance for every single market across Europe. You have that little note down there as to what we've actually aggregated there. The RevPARs are going to continue to grow, but you see that's all single digits, so we're returning to the normal pace where you will see RevPAR grow in single digits, 4, 5, 8% on any given month. Again, probably not a surprise that kind of the first couple of quarters are focused on the ADR because we're still feeling the pinch when it comes to the expenses, but as we go further into the quarters, into the latter half of the year or the first quarter of next year, it's going to be a little bit more occupancy focused. And I have mentioned that before a few times, that there are still hotels being built in pretty much everywhere across the world. And if you wondered how many rooms are there in a pipeline across the world, we've got 400,000 rooms, or 460,000 rooms across Europe. So that's about 8% of the existing supply. So if everything actually comes to fruition, there's going to be a whole lot of rooms, especially across Europe, that we sit in. Now, the biggest development markets in Europe, UK leading the way. There's always been a lot of new supply coming into various different markets across Europe. And you can see here very clearly the thing that I talked about, that majority of the development really goes into those middle classes, that light and dark teal being that upper mid-scale and upscale, kind of that cross between from the 3 to 4 star. The luxury is there down at the bottom in the dark orange, and especially in the UK and Germany, with in the UK with a strong presence of Travelodge and Premier Inn brands in the economy sector, and premiering, looking at a lot more development in Germany. So there's a lot more of that economy. Otherwise, as we go through it, you see Netherlands and Belgium there towards the end. There are still a couple of thousand rooms that are in the pipeline for both of the countries, but it's nothing compared to the levels that we're seeing for the big development markets of UK and Germany. Now, what we have in Benelux for the top 10 brands, now I have to explain that because I had to understand this myself. On the further side from me, in terms of the group, you're looking at the total number of rooms by the parent company. So various different brands opening in Benelux under the Marriott banner from the top. On the other side, you have the biggest operators across Benelux that are opening hotels. So again, Marriott managed properties. There's out of the 2,000, Marriott will actually manage almost 1,100 of those rooms. For the rest of them, it's a lot smaller numbers. So you're looking at probably 1, maybe 2 hotels up there for Accor or the Borealis Group in Benelux. So just that division, that's the total pipeline, and that's the operators on this side. And just to close out, just a few of those highlights that I've talked about. You know, demand is where we headed in 2019, and it's been very resilient, especially across 2023, and we're seeing that coming into 24 as well. ADRs continue to grow, but we're starting to see a lot muted growth in those single digits or maybe in the teens, but I would expect that for 2024, we're going to start seeing that single-digit growth rather than anything stronger because we're starting to get into normal patterns. The groups and the corporate demand is starting to come back. We've seen a lot more of that in the second half of 23 and stronger into coming into 24. Again, I've mentioned that China's reopened and a lot more of that group demand comes out of China, so we're looking forward to seeing that back. Big events, large-scale events like the Independent Hotel Show and all the other big trade shows, conferences and congresses are coming back. So that's going to, again, drive demand into all of those markets that have historically benefited from it. And historically, despite of everything that's been going on across Europe or across the world, hotels have been super resilient and there's a lot more coming in. So we're expecting that to continue through 24. And that's that from me. Are there any questions? Does anyone want to ask any questions? Now, I will be honest, like I said, I do look after Northern Europe. I'm filling in for one of my colleagues who couldn't be here. So I will try my best to answer any questions. But if I can't, I've got my colleague at the stand that might know a little bit more. I'll be honest.
I just wondered if you had any insights on profit flow through based on, obviously, there's an ADR growth happening. It's now stabilizing at 5% or so-ish, as you say. But obviously, costs have increased with energy and so on and so on. So what impact are we seeing on profit flow through?
So we do have some P&L data across Europe. From what I've seen so far, it is starting to stabilize and it is starting to kind of peak up above the 2019 levels. So we're starting to get there with a little bit more stability in the energy and gas prices. Labor costs have started to stabilize as well because the cost of living kind of starts to smooth out. So we've started to see that normalize and come to the levels of where we were and starting to see that profitability to come up a little bit as well. Anyone else? Everyone's letting me off easy. Well, thank you very much. If you have any questions, if you want to talk about STR or anything like that, we're at stand D36, so somewhere down there. I'll find my way back.